Hey guys, welcome to the Passive Investing Made Simple webinar and YouTube show. Thank you guys for joining us today. We are going to talk about all things passive real estate. We do this show live every Tuesday so you can build confidence into going into your first or next investment. And so if you haven't done so already, make sure to check out passiveinvestingwithwhitney.com. There, I've got some free goodies for you to help you learn the ins and outs of passive real estate, but also you can get access to my calendar and we can talk about how passive real estate can help you achieve your investing goals. Now, today I am joined by a very special guest, Chris Miles with Money Ripples. Chris, welcome to the show.
Hey, Whitney, it's good to be here.
Yes. Now I got perfect. I can't, I'm not even going to say disclaimer, but you guys, Chris and I go way back, like not quite 10 years back. Like Chris,
Yeah,
like
but
is
probably close.
very close. And so
Mhm.
Chris was like my financial coach way back in the day when I was scaling a single family rental portfolio. And I went, hey, hold on. How can I eke out more from my single family rental portfolio? Utilize my cash more wisely and scale. And so I have nothing but love for Chris, but also he's the reason why I'm here where I'm, on this trajectory that I've been on today. So Chris, thank you for joining me on today's show.
Oh, thank you for making me sound so old. I love it. You're like, he's my old mentor from way back in the day. He's like, you make me sound like I've been doing this for 50 years. Thank you.
I'm not trying to make you sound old. Hey, I mean, I got just as much gray hair as you do. It's just I dye mine.
That's my problem. I need to diet more often. Then my kids wouldn't call me grandpa sometimes, right?
Oh, that's awesome. Okay, so Chris, I take a moment. If I didn't do you justice on the introduction, take a moment and kind of help us fill in the gaps and let us know what Ripples is.
Yeah, a lot of people know me as like the anti-financial advisor because, well, I mean, I'm sure you talk about on the show from time to time, but I was a financial advisor myself over 20 years ago. And it took me about 4 years in that I realized I was just a salesman in a suit, right? In fact, it was funny because the whole reason I joined being a financial advisor was actually because I thought, one, if I could learn about money myself, that's great. But then two, if I could give my dad some of his life back, that would be worth it. Because my dad would always say things growing up like, hey, we can't afford this. What do you think money grows on trees? I'm not made of money, those kind of things, right? And I said, I don't want that kind of life for myself. So I want to have control. That's why I became an entrepreneur, is I wanted more control of my time, my freedom, my destiny, money, everything. Well, as a financial advisor, 4 years in, my dad said, well, when are you going to advise me? Now, understand he was the penny pinching saver, right? This guy is the guy that Dave Ramsey probably looked up to and learned from. That's the kind of guy my dad is. He's the kind of guy that doesn't tip at a restaurant. He steals plates from a restaurant if he doesn't get good service. I mean, that guy tips himself. That's how cheap he is. And so anyways, I sat down with him and looked at his finances for the first time in my life because he was always very guarded about his money, right? He was always worried about losing money. He was like the ultimate saver. And so he had paid off his house in 18 years. I said, Dad, that's a great job. I could see you've been stuffing money in your 401k for the last few decades and getting the match and everything. However, Dad, even though you're 61 years old and you've been doing this much saving and you're debt free, if you want to retire today, you better hope you die in 5 years because that's when you'll run out of money. Obviously, that's not the answer he wanted me to give him, right? But I did say, I was like, well, I don't know what to tell you because you've done everything right from what I teach as a financial advisor. And that bothered me. And it actually is when the student's ready, the teacher appears. A few weeks later, I call up a friend who I trained to be a financial advisor, but then he left to go do this crazy thing called real estate investing. And as I was talking to him on the phone, he says, Chris, my life is amazing right now. My dad and I have partnered on some deals to where we've doubled his income as a professor at the local university. I said, come on, that's too good to be true. There's no way that someone could like passively invest and all of a sudden double their active income. And he said, well, Chris, how many of your clients are actually financially free where they don't worry about money? Well, none. They all worry about running out of money too soon if they live too long. Okay, Chris, well, good job. Well, how about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these same investments? And understand this is like 2005, when I was talking to him about this. And there's guys that worked there since the late 1970s, 30 years, yet they couldn't retire either. And I said, well, none. He said, well, there's your problem. And that got me kind of going down this rabbit hole, right? Of learn about passive investing and actually doing what Rich Dad Poor Dad talks about, but never really teaches you how to do, right? And the next thing I know, as I start to realize you can do passive investing in different places, later that next year, I was able to retire when I was 28 years old. I had enough passive income coming in to pay my bills. And that was not what I expected. I did not think it was going to be that easy, right? Because I thought as a financial advisor, you got to save up your money in those 401ks and those IRAs for, at least 20 years. And then if you're lucky, you might be able to live on 3% a year, right? And that's just not what happened. It was so much faster doing it the way that I know you teach, Whitney. And so as a result, of course, everybody wants to know how a 28-year-old retired. So in 2007, I came out of retirement, started coaching people how to do that. The recession, then, even after I started that new business with another partner, a guy named Garrett Gunderson, even after we started that, the recession kicked our butts. We almost went bankrupt. I almost went bankrupt. I went from millionaire to upside down millionaire, where I actually was over $1 million in debt. Fortunately, did not go bankrupt, but I was able to dig out of that hole by the end of 2016, where I was able to be financially independent once more. And that's about, I think, the same time I met you, Whitney. It was about that same time when I finally was able to do it myself. And that's kind of what I do, is I teach people how to do that. Money Ripples, the whole cause is really to get people work optional, where you work because you want to, not because you have to.
Mm-hmm. Well, and it's such a wonderful mission to be on there because it's exactly what the name is. Like, you're going to learn how to utilize your own funds, what you're bringing in your work, in your entrepreneurship to, put money to work for you. But like that ripple effect that you're trying to create in the world is, so needed. Now, I know we're not here to talk or pitch money ripples today. We're actually here to talk about cash flow life insurance, because that is something that you are very versed in and, have a unique system built. And I know our investors, our limited partner investors, people here that are investing passively in other assets, they want to learn and understand cash flow life insurance, but they're trying to also figure out, the problem is like, how do I use this and and leverage it into a passive investment? It kind of makes sense if you're buying your own multifamily real estate, maybe in your own, like, single family or a short-term rental. But like, if I'm investing in somebody else's deal where I don't have control of the day-to-day operational decision, how does this all work out? Now, I always like starting at the very beginning. Let's first define what is a cash flow life insurance policy. Let's start there.
Yeah, I mean, you hear all kinds of different things, terms out there thrown out, like infinite banking concept, and then everybody's got their different words. We even call it max ROI, infinite banking. At the end of the day, if it's used properly and designed properly, it's a tax-free supercharged savings account, is what it is, right? It's a place that you actually have the ability to actually utilize cash, but keep it in a place that makes more than point nothing percent of the bank, where you make at least 5 or 6%, and it's tax-free. Because think about this. If you had a savings account that's, one, safer than the banks or the stock market, two, pays a lot more than even a high yield savings account, three, it's tax free, four, is protected from lawsuits and creditors in most states, 100% protected. That means you can have millions stored in here and no one can get to it. So you're protected from IRS and from creditors in that sense, if you think about it from a tax and a protection standpoint. And it gives you the ability to also create this double arbitrage where you're able to get your money to pay you twice when you do passive investing. That's the kind of thing that this does. And so, but unfortunately, most people talk about it as like this checking account you use where, hey, you're going to, pretty much pay all your bills with it. Don't do that. That's just a marketing scheme to get you to buy more with them. There's people that tell you to buy cars with it, buy your own house with it. And I'll explain why in a little bit, but for the most part, don't believe them either, right? The original book that a lot of people quote is a book that's written by Nelson Nash called Becoming Your Own Banker. And that's a good one to read, but it's a good start. It's not a good place to finish, right? And that's what I learned, because I'll tell you my story. I actually read that book in 2006 when I was starting to learn about this real estate game, because all these real estate investors were talking about infinite banking and had no clue what they're talking about. And so, because remember, I was a financial advisor and I'd never heard that term before. Well, they're all saying, yeah, you use this whole life insurance policy. I was like, whole life? Isn't that like the worst insurance I could possibly buy? Wouldn't I be better off just buying term and investing in the stock market? Wouldn't I be better off even buying like a variable life policy where I can at least get stock market returns? Why would I do whole life. Now, I didn't know anything about whole life, but from other financial advisors, they would tell me, oh, whole life just sucks. Don't do it. Right. But all these real estate investors are raving about it. So I started drinking the Kool-Aid after I read the book. I met with the guy that they all met with and sat down with him to set up my own policy. Even though I was insurance licensed, I was having him do it for me. And I sat down with him. I said, man, this is really expensive. Is there a way I can make this a little bit more cash rich in the beginning? He said, no, if you try to put in more money, you'll get taxed. So if you want to keep it tax free, don't do that. I said, well, I hate taxes, so I won't do it. Well, 2 years later, as I mentioned, I hit the recession. I was going from having all this extra cash flow coming in to where now I was in the hole like $15,000 every month that I was short on. And so I couldn't keep paying the $1,000 a month premium that they set up for me. So eventually I had to lose it. I had to stop paying because I asked them, it's like, is there any option here? They said, no, if you stop paying, you lose it because there was no cash to build it up. There's no cash savings account that was in there with any cash in it. It was all going to the paying for the insurance cost. Well, months later, as I'm talking with a friend who also had the same situation as me, we started to realize and discover that that agent lied to us, that you could have actually overfunded the policy, but just not the way he designed it. He designed it in a way that wouldn't allow you to overfund it. So I started running my own numbers because, again, I had an insurance license. So I started doing my own research, right? And I started to find out I could have had cash in there from day one. And if I did, I would never lost that policy. And so I confronted the guy. I had a 2-hour debate with this guy in his office. It got so heated to where the assistants outside could hear me yelling at him, right? And finally, after I knocked down all of his objections, because he said, "Oh, you should have a big death benefit, yada yada," right? All this stuff. It finally came down to, Chris, I did it that way because I couldn't afford to cut my commissions. I said, now the truth came out. Finally, you're willing to admit it. And I'm never sending you any of my friends or family again because I was referring him all the business, right? And so since then, that was about 2008. Ever since then, I've been kind of perfecting it and trying to figure out the best way to do it, especially a way that really aligns with business owners and investors and even passive investors. Because the truth is that most people, yeah, it's cool to have the life insurance death benefit. And if you don't understand whole life has two components where term insurance is just death benefit. You can only get paid when you die, right? It's death insurance. Whole life is actually life insurance. You have this tax-free savings account you can use while you're alive, and you have a death benefit. They're separate of each other, right? And so when I realized, well, hey, if we can design this to have more cash up front, this could actually be a good place to store your liquid reserves. And as I found out later, when you are leveraging it, you can actually use it to make more money than you would just using a savings account when you're trying to passively invest in other deals. And that's the thing that shocked me. So let me kind of describe what I mean by that. Like, for example, when most people set up a policy, the first 2 years of whole life insurance, everything goes to costs, right? Everything goes to cost for at least the first 2 or 3 years. It usually takes you at least 15 years or so to finally break even. Meaning, like if you're paying $10,000 a year, finally by year 15, the cash catches up to where you have 150,000. So you finally got a 0% net rate of return after like 15 years. The worst one ever seen took 39 years. Needless to say, we got rid of that policy and we did a new one. But it was pretty bad, right? At best, you might see 10 to 15 years in a traditional one. Even with infinite banking, with some of those people out there that talk about it, usually still takes them at least 7, 8, maybe 10 years to get that break-even point. We try to do it as fast as you possibly can without triggering taxes, which usually means you can usually hit that break-even point in about 5 or 6 years, And the cool thing is, this is how I fund mine. And this is how I recommend even people, if you're a passive investor, just like you're investing with these guys at Passive Investing, which by the way, I also send my clients to as well, a little plug for you guys. One of the things that I recommend people doing is, because there's always this debate, right? Especially in the infinite banking space, they always say, well, should I put all my investment money in here to fund it and then use it to go back out? But understand, in that first year, which is the most expensive costs actually go down in whole life over time, where term insurance costs go up over time. So with a whole life policy, when you set it up, those first 2 years have the bulk of the costs coming out. But instead of having 100% going to costs with how we design it, because it goes faster, only about 20 to 25% comes out in year one, maybe 12 to 15% in year two. And then by about year 3 or 4, it's paying for itself. So it's growing by more than what you're putting in. And so when people say, well, I should just probably dump all my cash in here. There's a lot of people in the real estate space right now saying, oh yeah, throw $200,000 in up front and then pay $20,000 a year thereafter. Well, okay, that's fine and all. That's fine and dandy, but Here's the problem. To get 200,000 into there, you have to raise up the insurance costs. So it actually kills the ROI because you have all these extra insurance costs coming out. But if I put in less amount up front, it's better. And here's the other problem. If you put in, say, 200,000 in that first year, that's the most expensive year. Why do insurance agents recommend you do that? To dump in tons in the first year? Because they get paid off of the insurance costs. That's a secret. If you ever want to know what insurance company or insurance agent gets paid, they get paid a percentage of the costs that come out of your policy. That's how they get paid. Well, they get paid crappy on the back end, right? When it gets to like year 3 beyond. But those first year or two, they get paid much better. So naturally, they say, well, throw in all your money up front when most of the costs come out in that first year. So if you put in 200,000, you'll be lucky to have $150,000 in there, meaning $50,000 of that 200,000 goes to insurance costs. And that's what they get paid on. So I actually had one friend, he was told to put $750,000 in and then 250,000 a year thereafter. By the way, just so you know, unlike Roth IRAs, 401ks, where they always cap you at certain limits of how much you can put in per year, there's not a cap. On the insurance, the cap is pretty much 25% of your stated gross annual income. So if you make 100,000 a year, you can put in up to 25,000 a year. If you state that you make, 500,000 a year, you can put in 125,000 a year and so on, right? I got especially a lot of real estate investor clients where they're like, well, I've actually made $1 million this year. Great. You can literally put in $250,000 a year into this plan. And the cool thing is there's no age rule like 59 and a half where you have early withdrawal penalties, none of that stuff, right? So there's a lot of cool things. Now, on the flip side, the other end of it, I only recommend people do this if you have at least 5 or 10,000 a year to save. If you don't have at least 5 or 10,000 a year, I would just recommend getting what's called a convertible term insurance policy that can convert to those plans later on without you having to requalify your health. So even if all of a sudden cancer hits, heaven forbid, or something like that happens, you still get the best rating that you had before that happened. So they have to give it to you. Even if they know you're about to die of cancer, they will still let you have the policy at that best health rating if you qualify for that up front. So I just tell people get cheap term if you can't do at least 5 or 10,000 a year. But otherwise, if you can do at least 5 or 10,000 a year to contribute, do it. And we have a lot of people that actually stop using their 401ks because they realize you put your money in that company 401k, especially if you work for that company, right? If you're the owner, a 401k makes no sense if you're the owner because you're gonna have to pay tax on that money anyways down the road, right? Even on your match, you still have to pay taxes on the match that you did. So you really got zero tax benefit. As somebody who's an employee, you might get a little bit of benefit, but the unfortunate thing is you put your money in a 401k, it's locked up. You cannot touch it. You cannot invest in these alternative investments at all, which sacrifices years off your life from getting more cash flow. But you instead use it over here, you can invest it wherever you want. And you don't lose the tax benefits. Because I know, Whitney, you got some of those deals that actually have some tax benefits associated to them. You don't lose it when you use it with this. Or if you did a self-directed IRA, although that can work in certain places, you don't get any of those tax benefits. So if you buy a rental, for example, this is a great way to buy a rental. If you buy, into like a business, a partnership and things like that, where you get business write-offs. You buy into oil and gas, where they give you write-offs on that too, where they give you some tax benefits there. Anything real estate, oil-based or business-based, you get to keep all those tax benefits, putting it here because you don't actually invest inside the life insurance. You use it like a savings account. That's the key. So anyways, I got a little bit distracted because there was a lot to teach on this, obviously, and I'm doing this without, a PowerPoint to keep me focused. But and Whitney, I'm glad you're just able to stay quiet. Your smile is worth $1 million here. So, but the whole point is that this can be good, but beware of like trying to dump in a lot of cash up front because there are costs. This is why you don't dump all of your savings or all of your investment money into this. So what I teach my clients to do, because my clients do the same thing that your people do here, Whitney, right? Is that they're looking to do passive investing. They're not big active investors necessarily. And so what we do instead is we use your emergency fund that you'll never invest with anyways. So if you have, ideally, hopefully you have an emergency fund. If you don't, well, now we know the next step. Now, if you're doing this kind of investment, I would imagine you should have an emergency fund too. Otherwise, you shouldn't be investing in passive deals without an emergency fund. But if you have an emergency fund, use that to fund those first few years where there's a net cost. Even though we've minimized those costs pretty well, still use those first few years using your emergency fund and don't touch the money you're going to invest. So the great thing is you can still put all of your investment money in the investments you're going to do. So imagine this, and I've had clients in this situation where maybe you have $250,000 you want to invest. and you know, hey, if I can make at least 10% or so a year, maybe more, depending on the deal I'm doing, this would be wonderful because now I can make at least 25,000 a year on my 250,000. But then that life insurance salesman comes and says, you should do this infinite banking thing, throw your 250,000 in here instead. But if you do that, you're going to have less than 200,000 left to invest. And you're going to say, well, doesn't that slow me down? And the answer is yes, because common sense would tell you you should have more money to invest, right? I know I'm almost like unselling this, but I really want to give you the warnings of, again, how you use it. So this is why I use my emergency fund to maybe fund for those first few years. So I'm not even touching my investment money. I'm still earning that, say on that quarter million, 25,000 a year. I'm still earning that whole period of time to build up my savings again, which can even pay for the second, third, fourth years if I wanted to. But here's the cool thing. By the time you get to that third year, remember, like I said, the way we design it, it's already paying for itself. So you have a net gain by at least that third or fourth year. So the cool thing is, even if you say, okay, now I'm going to use that 25,000 or more because you just reinvested that 25,000, maybe you saved it for 2 years, and you got 50,000. Now you're making like, say that, well, that'd be now 30,000 a year you're making, right? If it's making 10%. Well, cool. That 30,000 a year you can now have go into this plan, and you're going to have at least 30,000 in there that you can use to then invest. So that's a key distinction right there that a lot of people won't do because most of those insurance guys are just insurance agents. They're not investors or business owners. And business owners and investors, we all know we like to have cash and we like to have it available to use when we want to use it. So that's kind of how I teach people how to use it specifically. Now, Whitney, I know everybody's going to be asking, okay, well, how do you use it? Do you just, obviously you don't invest inside of it. It's not like an IRA. Well, how do you use it? You just withdraw out of it and then invest? You can withdraw the money. That is an option. However, once you withdraw it, now, of course, the money's gone. So think about this, like with any savings account, even though this is a higher yielding savings account, right? Still, like with any savings account that you have, once you pull the money out, you're now, and you go and invest it in that place, you're now making money in that one place, which is where you're investing, whether it be in, it could be a car wash, it could be, it's kind of real estate backed investment, whatever it might be, you have it there. But now your savings account is no longer paying you, is it? Because you just drained it. It's gone. Here's the key thing. This is why you hear people say, borrow and pay yourself back. First off, you don't do that. I'm going to explain why. Don't believe those lies. If you ever watch social media stuff about infinite banking, they do kind of lie to you about this, but there's some half truths that go with it that actually make it more awesome than what they talk about online. And it's this, right? It's that you can actually withdraw the money, or if you don't want to lose the ability to earn compounding tax-free interest on that money while it's in the policy, you can then get a collateralized line of credit from the insurance company. You can borrow from them. You don't borrow from yourself because people say, why would, people have studied this. They'll say, why do I have to pay interest to borrow my own money? And the answer is you don't. You're borrowing their money, just like you would a home equity line of credit, but the rates are way better than what home equity line of credits are right now. They're right around like 6%, which is funny enough, about the same that they're paying you is about 6% in tax-free dividends right now, right? Well, when you borrow that money, you're borrowing it from the insurance company. The good news is it doesn't show up on your credit report. You can have a 480 credit score and you're fine. It doesn't matter. Credit scores don't matter here. It's not even on your credit report. And even better, there's no minimum monthly payment to pay it back. You pay it back, however, whenever you want. The deadline to pay it back is your death. Because when you die, they do eventually want their money back. So they'll just take it out of the death benefit and then pay the rest of your family tax-free. By the way, the death benefit's also tax-free. That's another thing that's kind of cool. So what's kind of cool is, yeah, you're paying them interest, but this is what you do. So say that, for example, you go, use $100,000, you go into a passive investment, and say that passive investment pays you $10,000 a year. Now, yes, they're charging you interest and you're making about 10% there, but you're going to take that 10,000 and use it to apply back towards that line of credit. Now, if you do that, here's what happens. You're not paying compounding interest. Understand there's two types of interest that are being charged to you and or paid to you. There's compounding interest and then there's simple interest, and they are not the same. Like, for example, it always shocks people that, I show them this, well, actually, you know what? Why don't I show it this right now? Can I share some slides? Is that possible?
Yeah, let's do it.
Because this is one reason why you realize you may not want to pay off your house. So, so I'm going to start it from, I'm going to start from that slide. I'm literally about to share this same thing in a couple hours.
And for those of you who are listening in after the fact, make sure to go back onto YouTube and look up the video so you can see these slides.
Yes, definitely. You're listening to audio. You want to look at the video. I'll try to audibly describe it, but every time people are like, wait, I got to see this. All right. So if you got a $300,000 mortgage on your own house and you're paying 6% a year, over those 30 years, if you pay the minimum payment, you'll pay 347,000 of interest. Now, when I used to be a mortgage broker back in those mid 2000s, because in 2006, everybody could be a mortgage broker, right? Kind of like 2021 was. And so I would always tell people, I'd say, hey, if you want to kind of screw the bank, if you want to kind of give it back to the bank, pay this off early. Not knowing that the bank was clapping the entire time I was saying this. Now, why would you say that? Why would I say that the banks want you to pay off your mortgage earlier? They love it when you pay extra payments to your mortgage. They love it when you pay it off faster. That's why they incentivize you by giving you a lower interest loan mortgage on a 15-year mortgage or a 10-year mortgage than they will on a 30. Because if they really want to make interest on you forever, wouldn't they give you the lower interest rate on a 30-year mortgage? Because they'll say, hey, I want you to do this. Because they know we're not idiots. We know we like paying lower interest. They would all incentivize us to do 30-year mortgages only because over time, if it actually did compound, you would pay way more in interest, right? But they don't do that. They want their money back faster because for every extra dollar you pay in principal, they have the ability to loan out 10 more dollars. They're the true investors, right? They love leverage. So if you pay an extra $1,000 in your mortgage payment, guess what? They love you because now they can lend out $10,000. You get what I'm saying here? So mortgage companies love showing you how much interest you'll pay over life long as they'll say, wait, you're paying more than double the actual value of the mortgage. So pay it off faster. Pay those extra biweekly payments, which really don't give you any advantage at all. You might as well pay once a month extra and you'll save more in interest that way, right? But they're trying to tell you to do that because if you keep paying it down more and more, the more principal you have in that property, the more equity you have. If they ever have to foreclose on you, they're safer because as an investor, if you ever lend out your money, you're always looking at what's the loan to value, right? What's the loan to value on that property? Is it going to be, 65%? Because if so, yeah, maybe I'll lend it because if you default, if you don't pay me back my money, guess what? I'm going to foreclose on you and then I'm going to sell the property myself and get my money back and then get some gains on top of my interest, right? That's what a bank loves you to do. They're the same as any other investor. They want their money back and they want it fast. So this 6%, you'll pay 347,000. Now here's the real question. So what if you had 300,000, you could pay it off today, but you didn't? Instead, you kept that 300,000 in a crappy CD earning 3%. How much do you think you'll actually earn in interest over those 30 years on that $300,000 at 3% when it's only half the interest rate? So if at 6%, you're paying 347,000, what do you think it is at 3%? Whitney, I know you already know the answer, so I'm not even going to ask. But watch this. Oh, yeah, what if you invest it, right? 3%, $428,000. You're like, wait a minute. That's almost $100,000 more than I would have paid in interest. How? Because it's compounding versus simple interest. They're not the same. You guys ever seen like when you pay down car loans, right? If you pay down car loans, you'll see that the more your payment goes to paying principal as time goes on, right? Same thing with mortgages, more pays towards the principal. Many people believe falsely that the bank is just trying to screw you over, but it's literally just math. It's just math because as you pay at least interest only or even pay the balance down, less and less gets charged interest. They're still charging the same interest rate, but there's less to charge you interest on as you pay that balance down. So that's what happens when you have a loan type of payment when there's principal and interest involved. Even if you pay just interest only payments, it's still simple interest. It doesn't compound against you. It doesn't get more expensive. Where the 300,000 sitting in savings does get more expensive because even if you earn 3% on 100,000, the next year you may now being paid 3% on 103,000. Then it's like a 103,000 or 106,000 and change that you get paid on interest, right? It just has that compounding curve where the opposite is true with simple interest. It goes down. This is why you could have a higher interest rate on the loan with an insurance company and still make more money. By the way, watch this. Even if you earned the same interest rate, which is kind of closer to what you see with life insurance loans, guess what? You would actually make 1.423 million. Do you think you give a crap about paying over $300,000 in interest if you knew you made 1.4 million? That's a pretty good return on investment, right? So
And
you
is this
wouldn't
over
care about
30
that.
years? What's the timeline on this?
This is 30 years, right? Correct. Same 30
Okay.
years as that 30-year mortgage, right? 10%, that same 300,000 grows at 10% to almost 5 million for for those of you guys that like to invest in good old syndications. Or if you have a syndication that does really well, if it does 15% over time, IRR or whatever it might be, right? Guess what? That's almost $20 million, even though it cost you 347,000 in interest. Do you think I care about paying that 347,000 interest? No. This is actually why I actually financed my vehicle 3-year term. I didn't do it for very long at 3.9% because they offered a special promotion. They're like, well, yeah, we'll do 3.9%, which was almost half the rate they were going at that point. I said, well, yeah, I'll do that. I'll make way more than 3.9% investing it. So I'm going to use the bank's cheap money. And that's the key thing here, guys, is that that's how this also works, is that you want to be able to get that compounding interest. So as you take your cash flow from the investment, the passive investment you have, you use that to start paying down the balance, less of this gets charged interest, more and more compounds inside of it. And so I even use an example. If someone had $250,000, they put in an investment that paid them $2,500 a month. If you were to put that money back into your savings account, that $30,000 a year, $2,500 a month over 9 years, after you pay taxes on a 0.2% savings account, you'll have a whopping $1,228 of interest that you earned over 9 years. Nothing to get excited about. I did that same exact example, again, $250,000 down payment on a property, right? Making that 1% a month or 12% a year, and using my own insurance, even though there's insurance costs still involved and everything else, but because I'm making this compounding tax-free interest, even when I take the interest that I'm paying out, even when I take that out of the equation, I still net over $126,000. I literally make 100 times more than I would at a bank, which, by the way, my current credit union only pays me 0.1% on my money. And then I still have to pay taxes on that 0.1%. Here's another bonus tip, by the way. If you have money sitting in savings, like I talked about your emergency fund, for my family, my wife wants to have at least $400,000 that we just never touch, right? Don't invest it, don't touch it, just let it sit there. Which, of course, the 2022 version of me said, holy cow, I'd be losing the interest. By the way, in 2022, I realized when everybody was saying don't hold money in cash, that's when I started holding money in cash, because I realized the best investors always do the opposite of what everybody tells you in the media, right? Which turned out to be good, because now I can do anything I want with more cash. So I had 400,000 there, and I'm like, well, if I let 400,000 sit in my bank account at 0.1%, I make $400 a year in interest. And then I got to report it to the IRS and pay taxes on that money. So I might walk away with maybe $300 if I'm lucky. However, I told her, I said, why don't we earmark 300,000 of inside of my life insurance policy that I have here? What if we just earmark 300,000 that we don't actually invest with? We just let it sit there. Even if I only earn 5%, which I earn more than that, but even if it was just 5% I'm earning tax free, guess what? That's 15,000 a year I'm now earning on my savings. And I still have 100,000 in local banks or high yield savings accounts, diversified between those two things, that will pay me at least $100 a year in interest, right? Or a little bit more maybe. But I'm now making like at least 15,000 a year tax free that I never have to file a tax form for. Which, by the way, the more investments I do, and I know you know this too, Whitney, the more investments you do, the more freaking tax return forms you have to deal with, and it just becomes a headache. I love the fact that I have one form that I have to use. So this is how you can actually get a double dip effect. You can actually earn net interest inside your policy because it's compounding more than what you're paying in simple interest. And because it's all in there, that 100,000 you didn't actually take out, it's still there earning compounding interest while you're also earning money on your investments. And especially if you're just going to be taking that money to reinvest and keep cycling through, I call it the income avalanche, right? As you take the income that you're earning in passive income and then reinvest it again to keep compounding your income. That is exactly what this is meant for. It's great. So I first and foremost use it as a storage for my money, my cash reserves. And that's why I have at least 300,000 I never touch. But anything above that 300,000, free game to use. Example, one of yours, my mutual friends, he was having a lot of syndication issues, with his apartment buildings and whatnot. And one of them I was in. So naturally, he's asking for capital call money and all that stuff. I'm so glad you guys don't have that kind of drama at your company, because those capital calls are not fun. But he was having capital calls left and right with all of his deals. And so one of them he tried to do, but he couldn't raise the capital because people are like, why would I throw good money after bad if I don't know if I'm going to get this money back? Well, he finally just said, hey, you know what? I'm willing to borrow $50,000. I'll pay 15% on. And that's when I raised my hand. I said, okay, I'll do that, because worst case scenario, he has to pay me back before he pays back us as the investors, right? Because I'm in the debt position where I was, the other position was an equity position. So I literally loaned him money for 3 months until he could sell the property off. So he had enough operating capital to do so. And then he paid back my 50,000 along with the extra interest was about 2,000 bucks. But guys, I actually used my policy instead of using my cash from my bank. I could use the cash from the bank, but I thought, why not use my policy for this? Because yeah, they'll charge me some interest, but because the interest comes back so quickly, I'm able to put that money back in. I still net more interest because they were paying me interest the whole time on that same 50,000. They were still paying me compounding interest tax free, and I made interest from him too at the same time. So I ended up still, I might have netted like $100, in extra interest, but if I can get free interest for just doing the same thing I would do with my savings account, why not? Right? Even if it's just for 3 months. Other things, other ways you can use it too. You can use it as collateral. Not many people know this, even, unless you've watched documentaries or something on Walt Disney. But it's actually very common knowledge that Walt Disney could not get the bank to lend him money for the swampland in Florida, right? Disneyland was a hit, and they all knew that. But when all of a sudden he said, I want to do this bigger and better now, and I want to do Disney World, they said, yeah, you're a dreamer and you're dreaming. We're not going to give you that money unless you put up some collateral. So it's common knowledge. Walt Disney took a little HELOC out, and he actually got collateral from his cash value that was inside of his whole life policy. So he says, listen, bank, why don't you tie up that collateral, tie up that money, and now will you give me the loan? And they said, yeah, absolutely. We can tie up that collateral so we have a guarantee of some money there that you won't touch because we know you like to spend money, Walt. That's why Roy was such a good partner, because he was the one that was trying to keep the money away from Walt half the time. But they were like, yeah, we'll give you the money. We'll give you them. And that's where the happiest place on earth came from, right? Was actually from using his life insurance policy. Ray Kroc, who bought McDonald's from the McDonald's brothers, he couldn't afford to pay the executives up front when he just purchased the franchise. And so he used his whole life policy to pay their wages, pay their salaries that first year. JCPenney actually pulled themselves out of bankruptcy and even paid payroll using their life insurance. So this is not something that's been done one time. In fact, I know two people that come from a family that own banks. And it's also common knowledge that banks will also own life insurance. They own usually anywhere from about 10 to 20% of their cash reserves will be held inside life insurance cash value, not the death benefit, but the actual cash savings account. They'll hold it there because they have more leverage using that, because it's actually a capital that they'll let them loan out 10 times their income or 10 times the money that's in there. So they'll store money there and use their life insurance policies too. And even with these two people I know that came from families that own the banks, they won't even store their own money in their own banks. Think how ironic that is. They actually store their money in the life insurance policies instead of their own banks that they own. Why?
Why is
Because
that?
it's actually safer. What's that?
Why is it safer?
Well, here's the difference. We all hear about FDIC protecting your money, right, at the bank. You have up to $250,000 protected by the FDIC. But how much money does the FDIC actually have in their coffers? It's like 1.5% of the total savings that's in America today. So think about this. The Great Depression, right? This is why we saw issues with banks. The Great Depression, there were 35,000 banks in 1929. In 1935, 13,000 were left standing. About 2/3 of banks failed because, again, they didn't have enough money. This is why FDIC came to be, right? But even then, like the Great Recession, what if we had 10% of banks failing, but you only have 1.5% sitting in FDIC? There's not enough money to pay you all back, at least not in a timely manner. This will be like when everybody's trying to get COVID relief and they're still waiting and waiting for the checks to come, if you remember that, right? And everybody's freaking out. They're like, you told me I'm going to get the money, but where is it? Well, they had to basically fake print more money so that they could give it to you, right? They had to create out of thin air and drive up inflation to do it, right? That was what would happen as well if we had another situation like last year. We started to see some bank failures, and somehow these big banks, just 3 failed. Although we've heard other smaller banks have failed, they just don't make news. But we already know that banks are already stressed out, right? We already know that they're having issues. If we have more unemployment, more of a recession happening, those banks are going to be stressed, and you don't have enough money in FDIC to protect your own money. So with insurance companies, the difference is this. By the way, in the Great Depression, only 4 life insurance companies failed during that period of time. Why? Because they have what's called reinsurance on them. They legally have to buy insurance on themselves, kind of like FDIC, but they protect all of your money and your death benefit. And because insurance companies cannot lend their money out like banks do, where banks can lend out and become over leveraged, right? That's one thing that the big five banks did before the last recession, is that they got Congress to give them permission to loan out 40 times the money they had in reserves. 40 times, 40 times the debt, right? And even with Fannie Mae, Freddie Mac, it was 100 times. So we were basically bailing out those that were way over leveraged, you know? But with insurance companies, they can't do that. They can only use the money that they have, and they invest only in like treasury yields and things like that, which is also nice because as interest rates have gone up, guess what happened to the dividend rates? They also follow suit and they go up, and they move more slowly. So they're just now starting to go up, which means even if rates come down, they're still paying higher, even after your little high yield savings account drops down to like maybe 2 or 3% down the road, right? So there's a lot of things like that. So that's why it's safer than banks, because they just don't fail. Because even if they were, the reinsurance companies step in until either somebody can buy out your policies, or the reinsurance company just owns it for the rest of your life and make sure that there's always the cash protected and that the money's there. I actually saw this firsthand with the insurance company that I used to be licensed with, that I actually ended up having to sell out to another insurance company. All those policies were protected. They moved right over. Nothing changed. So that's one of the cool things. And I actually like to use companies just as another you know, side bonus, teaching here too. I like to use insurance companies that have paid dividends consistently for at least 100 years. And when they pay dividends, that's not their minimum. Their minimum is the guarantee, right? Most guarantees are right around like 3% right now, maybe 4%, but they're currently paying closer to about 6% right now. Well, a lot of the companies I use have paid for at least 175 years straight, where they've never missed paying more than their minimum payments. So that's a pretty good track record. You can't find that really anywhere else, right? Even among banks, that's pretty hard to find. So that's why I trust insurance companies even more than banks. That's why I keep the bulk of it, not just because it pays me more, but I know that money's better protected. Speaking of better protected, like I mentioned, in most states in the country, you are 100% protected from lawsuits and creditors. So if anybody sues you and wins, you can literally have millions stored here and they can never touch it. They cannot get to it because it's protected, because they classify it as not an asset. At least not when it comes to legal purposes, they don't call it an asset. They call it as part of your death benefit, and that's for the family, not for you. So they have to go for your savings accounts. They can go for your IRAs. They can go for almost anything else that you own, Bitcoin, whatever, right? They'll go have you cash out that first, or even put a lien on your property, but they cannot touch the life insurance. So that's one huge perk, especially if somebody that's in the real estate space, or even if you're a business owner and you're afraid of ever getting sued. And if they ever happen to pierce your corporate veil, right, where they happen to go suing your personal assets too, that's the one place they cannot touch it. So that's another reason I like to store money there too. So, I mean, there's just a whole bunch of reasons that I use it. But again, I'd say if there's a negative, it's the fact that, yeah, there's net costs up front. So if you're only going to invest for 2 years, don't do this, right? Like that's not going to work. If you're planning to keep investing and get passive income for at least the next 5, 10 plus years, then this could be a great fit.
Well, Chris, this has been very enlightening and education, on like the various, ways that life insurance can protect you, how we can, shield money from, creditors and creditors and predators. I almost said the IRS in there as well.
Just taxes, but they could, if there was a tax lien, they could get your money there, because the IRS can get to anything. They can get to Cayman Islands, they can get to your insurance if you
exactly.
owe them money, right?
I want to make sure we leave plenty of space for questions and or ask me anything
Yeah.
part of the show. But just real quick, maybe, take a minute or two. Somebody's interested in learning more about this or wants to connect with you and, explore whether setting up a policy is the right move for them. How can they do so?
Yeah, and actually, this will be. I'm kind of doing something just for your people here, Whitney. Is that I'm actually having people meet with me, because usually I have them refer to my team, but I'm actually going to meet with people personally. So I do have a few spots open in the next few weeks that someone can book. To make it easy on you, I decided to try to actually do this. I actually made a QR code and a link. So in case the QR code doesn't work for you guys, there's also a link you can use too. So if you can scan that QR code right there, if that doesn't work, then here's the bit.ly, /passive_investing is the other way you can do that. And it just literally goes to my calendar. You can book a time. If you go to moneyripples.com, you won't book a time with me. You'll book a time with someone on my team. And he's actually booked out to almost September right now, because I just did a webinar on this to like 400 people last night, and a lot of people wanted to figure out how to do this for themselves because they also want to protect their money and grow it too, right? So yeah, definitely just scan that link. Now, if you're listening, it's the link is https:// bit.ly/passive_investing. And so if you go there, you'll be able to book a call. So
Awesome. Well, Chris, thank you so much for your knowledge and expertise, and more importantly, your time here today. Guys, if you're here live, don't go anywhere. We're about to start our Ask Me Anything part of the show.